Hey everybody, we are here at the CU Digital Town Hall number 61, if you can believe that. June 2021. I know 61 of these, Bryan. Man, and they just keep getting better and better. And now that you're on the program, it's that much more better, if that's proper grammar.
More better. I like that.
It's more better.
It's more better.
Exactly. All righty. Hey, again, everyone, hey, welcome to our CU Digital Town Hall. I'm not sure where John is this week. He might be, I don't know, working on SpaceX
he's in Tennessee.
Tennessee. Wow,
Tennessee.
What's going on there?
Wow, he's closer to you, Bryan, than he is to me. So
come on over.
So I will be your guest host today, or your substitute teacher. So behave, everybody. I'm Mike Lawson with CU Broadcast, and hey, Jonathan Silly's here. All right. See him in the house. Good to have you back, Jonathan. And we want to say a special thanks to our sponsors, the fine folks at CUNA Councils who put on those fantastic conferences that we're all going to be getting back to in person later this year, and especially in 2022. So thank you very much, CUNA Councils. And then the fine folks at Correlation, one of the more progressive core processors out there, absolutely shaking up the industry in a good way. So thank you very much, Correlation, for supporting the show. And then we have CU Broadcast. That'd be me here. So that's all right. And then we got the fine folks at Best Innovation Group, or BIG, so who created this whole thing. So appreciate everybody involved. And we also appreciate all the attendees who come and just watch and listen, and even more so participate. So we're looking for a lot of that today, because Bryan, our special guest, Mr. Bryan Clagett from Movin', he is joining us today, and we're going to talk about a number of items. But before we get started, Bryan, I thought you were supposed to be retired. What's going on with you? You're busier than ever.
You know, I think it has something to do with my wife saying I'm not allowed to be retired. So I have retired twice before. You know, yes. We sold Gizio, and then I decided I'd retire. But a day later, I went to Strategy Corps, did that for 9 months, and a day later, I started consulting to. I work with several fintechs as well as a financial institution, just on the consulting and advisory side. And, you know, Brett kind of kicked me in the rear end and said, you need to come on full time and help do for us what you did for Gizio. So, you know, here I am. I'm doing it day by day and having a good time. My rule of thumb is, as long as I'm having fun, I'm going to keep on doing it, because I'm at that point in my life I have that luxury. Yeah,
exactly. Well, good for you. Well, we're happy to have you back in the mix, and you're doing some great stuff for Movin' already. I see a lot of news about what you guys are doing there, and you're already stirring it up, sir. So thank you very much for that. And dude, I want to start off with the big news of today, Bryan, that El Salvador, first country to accept Bitcoin as legal tender. What are your thoughts on that?
You know, it's interesting. For one thing, we've got a client, Banco Antalita, which is in Honduras, and we're currently doing a financial wellness deployment for them. And El Salvador is the next country in line. We're actually in the middle of scoping it. We're excited because we have a Bitcoin relationship with NYDIG. El Salvador is a very unique country. The current governor or president, I guess you'd call him, is came in as being a champion of democracy, but a lot of the people in El Salvador don't feel that's the case.
Yeah.
So I'm not sure what it means for El Salvador. I will say to this, you know, Latin America requires a lot of mobility in their economy. So things like digital wallets and crypto, frankly, probably make sense. Not unlike with some of the other countries we work in, where there's a lot of remote markets that are difficult to reach. Getting currency at the quote unquote bank can be difficult. So it's a progressive decision that they've made. We'll see where it goes.
Yeah.
You know, sometimes with crypto, there's a lot of question on, you know, legality and how it's used. You know, it's been used for money laundering for years, as you guys probably know. If you watch Billions, you kind of might have seen that episode. But I believe it'll be used for good, and I think it makes sense.
Yeah, I agree. And should we, I mean, how will this kind of ripple, what's the ripple effect of this, and how coming into the United States? And more importantly, will it have any impact or effect on credit unions, do you think?
I'm not sold that there'll be a ripple from El Salvador. I think the ripple's beginning already.
Okay.
You know, NYDIG is a great example. They came out of the market and flat out said that we want to bring Bitcoin, specifically Bitcoin. They only do BTC, and bring it into the retail banking ecosystem. And obviously that includes the credit union industry. It's an asset, right? It's an asset that is held. So it makes sense that the financial services industry, including banks and credit unions, look at a way to help customers or members, in essence, hold that asset. Now, that's kind of number one. So PFMs, for example, including kind of what we're doing at Movin', we have the ability to buy, hold, and sell. The hold to me is most important because it's an asset. I dabble in it. So it's, let's say it's $5,000. I want to show that asset, and in nanoseconds, I want to show the fluctuation of the value.
Right.
For me, it's not yet a currency, not unlike what they're doing in El Salvador. I'm using it as just an asset that I hold. And most of the bankers I'm talking to, that's kind of what their focus is on first, as opposed to looking at it as a true currency. So I don't think there's a ripple effect from El Salvador, but it is something that is on the radar of an awful lot of people right now. It's not going to go away. I think that increasingly it'll become legitimate, and it'll be something that if you want the younger audiences or you want a more sophisticated audience, you're going to have to find a way to be part of that action. And that'll be buy, hold, or sell, probably at least hold.
Or who was it? I mean, like a lot of the sports professionals, I think
Mark Cuban, he's all over Doge.
Can you give me a bonus in Bitcoin, or?
I think LeBron James is involved. Obviously Mark Cuban with Dogecoin, and it's become kind of a meme, kind of not a stock, but a meme asset, because of, people like Elon Musk get out there and say one thing and the market goes up or down based on it. That instability in the market for some people, especially the people like to churn, is exciting. There's people out there that make a lot of money on churn. It reminds me of the late 90s with biomedicals and penny stocks. There were a small group of us that had a tolerance, and we were able to kind of, gamble per se. There's a certain amount of that's occurring, but eventually it's going to settle down and it'll become more legit as time goes by. I think the other question is which crypto will become the most dominant. I don't have an answer for that because they're being invented almost daily right now. Doge started as kind of a joke.
Really?
It started kind of as a joke, and now it's very legitimate. So for me, the one that I'm most interested in is Bitcoin.
Yeah. So, and last question on the crypto topic is what should credit unions be doing right now to prepare themselves? I'm sure a lot of folks out there are experts in this area and are already making preparations, but just for the average credit union, how should we prepare for this?
Determine the need. Get out there, understand what your members are looking for. Look at it from a household level. If you've got a high percentage of millennials, for example, get out there and ask them what they're doing with it. You're going to find out, and I don't have the statistics available, but you're going to find out that a lot of your members are already engaged in it in one way or another. Find out who they're using, how they're using it, why they're using it. A lot of these crypto wallets and providers out there, the Coinbases of the world, they're going to be looking for partnerships. And, I know that FIS has gotten into it recently through NYDIG. I haven't heard about Jack Henry or some of the other cores, but I expect you're going to see them more and more get into it. But you better understand what the market need is. It can't be just something you experiment with. It's got to be something you're going to have to dedicate to. Chances are your core is going to offer something or some of your other partners. It could be another fintech. But first understand what the need is from your customer point of view. There's geographic concerns. Hey, I've got, just as a side note, I'm working with a banker in Minnesota, like a banker, like Thurston Howell, the third banker. He wants to start a crypto-only digital bank.
Really?
And this is a $150 million family-owned bank. Now, my question to him was, especially in the part of Minnesota he's in, he's way up there, right? The Thousand Lakes, I think they call it, right on the border. So I'm not seeing lumberjacks with Bitcoin needs, but he's done some market testing. He knows that he wants to expand his franchise. So he's doing this homework, and he's determined that there's truly a need. Whether he can pull it off remains to be seen, but he will be in the crypto business in some way.
Wow. Well, the way the price of lumber is going, you might need to use some crypto to buy that.
Yeah.
So.
Yep. No doubt about it. Yep. $70 for a sheet of plywood the other day. Firsthand experience. Yep.
Oh, lovely, lovely. Well, I'm glad you brought up the cores because I'm going to do a little switch. I'm going to switch gears here a little bit, and I'm going to give you a shout out too because you just had a really informative panel discussion with Ted Brown from Digital Onboarding and Stessa Cohen, formerly she was with Gartner, right? And now
she was with Gartner. She's got her own shop now. Has a great newsletter. I'll send you a link to it so you can share it with your friends.
Cool.
Yep.
Yeah. And so the title of this panel discussion was "Think Like a Challenger," and I'm thinking you're referring to the challenger banks out there, how banks and credit unions can compete and win. And one of the topics one of the questions that Stessa brought up that I nearly fell out of my chair when I heard it. She goes, "Are core providers able to weaponize bankers?" I had to take a double take on that one. So I want to get your perspective on this, and maybe Tom or Jonathan or somebody else would want to chime in as well, because obviously Correlation is one of the show's sponsors. So I thought it was kind of appropriate to bring that up. So what's your thoughts on that, Bryan?
There are a lot of variables. I'm not one of these guys that likes to bash the cores. And I don't even think they're a necessary evil. I think they're an important part of the retail banking or any banking ecosystem. I think most are moving towards a more open architecture, a more embracing ecosystem, where in essence, yes, they will be able to quote unquote weaponize their banks and credit unions. They're going to have to survive. I actually think that the cores conceivably have more liability and risk than the typical financial institution. There are new cores being developed day in and day out. The banking as a service model is here to stay. I think most, if not all, strategically have a vision where they will be more open to open banking and embedded finance. And as they do that, they will be able to offer best-in-class components, banking services and features that they don't offer today. And that would weaponize the banks to survive. And that's the key word there. Weaponization is for the benefit of the banks to fight off the challenge of the challengers.
Okay.
Right.
Gotcha.
It's about market share. Right now the defense that most banks, for example, have is M&A activity. Right. We've all of a sudden seen a lot of mergers over the last several days. You mentioned Tennessee. Simmons Bank bought 2 in Tennessee yesterday. Maybe that's what John's doing. He's nosing around on those. But so there's going to be more and more M&A activity occurring, and scale is important. I think the cores are smart enough to know that they've got to do something to help. Now, will they weaponize with a shotgun, a sniper's rifle, or a bow and arrow? That remains to be seen. Yeah. Some are better than others. There's no doubt about it. But I think all are in the game to win.
Yeah, because I remember earlier in the conversation, you mentioned that cores are at risk more so than financial institutions.
I believe it. Yeah, I believe it. Not just from kind of a shareholder's perspective, but the banking industry, the whole banking ecosystem, and fintech partners out there, the Movins of the world, the MXs of the world, they're looking at the cores to bring them into their environment or the ecosystem, and most are beginning to do that. If the ones that don't open up, the ones that don't drive transparency, the ones that don't listen to their credit union, technologists to bring new technologies or an open platform to market, those are the ones that are going to be at risk.
Yeah.
So the need is tremendous, and there's a big opportunity for cores to really differentiate themselves. And that's one of the reputations I hear about Correlations. That's good. They're easy to work with, right? I mean, very easy to deal with. That's important.
And they have the open architecture. I think they were genius in creating that model, and now they're reaping the rewards, so to speak.
Yep.
So a lot of people are watching them and using them. So as Tom O'Shea can attest to.
Hi Bryan.
Hi.
We're a correlation shop. We're a correlation shop, and they are a fully exposed API, and they're really the only one that I know of that is prepared for open banking, and that's key to me. If you look at the European models and all, it was legislatively though that forced those banks and FIs to be open to go into open banking, and you may need the same type of legislation here in the U.S. because that will drive down costs, that will open up banking to under and non-bank people. And if you're with the other cores, they talk a good game. But, quite frankly, from my conversations with Fiserv, they're open banking, but only to their own family. Otherwise, it is an extremely expensive and high hurdle for people like you guys. If I wanted to connect with you, and if I'm a DNA shop, for example, it's expensive, really expensive. But if I'm with like a correlation, and I think maybe some of the newer ones that are really, really tiny cores, when I'm with correlation, it's almost free.
Yep. And I think that's where BAS comes in. I look at what Q2 does with BAS. So they're a virtual core that works in parallel to a traditional core, but there's no direct correlation between the two, no pun intended. And it's a very unique environment. Now, a lot of people don't know this, and this is not an ad for Q2, but Q2 actually supplies the banking as a service for Betterment, Acorns, Square Bank, and several others. These are unicorns, and they're doing it on a virtual only core. The value there is you can stand up a digital bank, stand up a companion app, stand up a unique mobile environment that's not dependent on your traditional brick and mortar core, if there's such a thing, or legacy core. Quickly, 90 days, we can stand up a bank now. It's remarkable. Nimbus is another example. Galileo, another example. These virtual cores are adding a lot of pressure to the traditional legacy cores. They're going to have to open up. Fiserv, to me, when I think of Fiserv, I think of payments, to be very blunt. That seems to be where they put their stake in the ground. I don't know what their strategy is, but I'm willing to bet that they will invest more in banking as a service, and slowly but surely will open it up. How fast they do it will probably be a critical decision for them, because if they don't, they're going to lose market share.
Yeah, and I'm not sure if this is related, Bryan, but you also mentioned there about Citibank, and they have 3 core systems that don't even talk to each other. And so how does...
legacy, when you challenge the challengers, sometimes the challengers challenging the legacy thinking that is in with the, your own organization. Citi's got a good brand. They've got a, great franchise, Chase 2. Yeah. But what I got out of Citi is I spoke to a gentleman who was hired. He was a former fintech entrepreneur. He was hired specifically to break down the silos in technology. So you've got a separate platform for retail, a separate platform institutional or commercial, and then a separate platform for trust and wealth. And the systems, whether it's middleware or whatever, don't talk well together, and they're not leveraging that technology stack. So they're having to reinvent their own technology system and to create more of a customer-centric experience. Now, some of these barriers are due to legislative and regulatory challenges. And unfortunately, I think all industries hide behind the rules sometimes. They say, we can't do it because the rules don't allow it. Well, there's a lot of ways you can impact the rules, and there are a lot of ways to work around it. I think when it comes to how data is shared and how experiences are built, every financial institution should be looking to remove those silos. I was surprised how siloed they were.
Yeah, I mean, that blows me away too, because you would think, organization of that size, that magnitude, and probably the R&D dollars that they have, you would think they would have some sort of, continuity there, or some sort of.
And they're addressing it. I mean, they're throwing some big money to these former founders of fintechs, and they're going to fix it. I mean, I really think that the biggest threat, and Lisa Kuhn-Phillips brought this up on the last call we did a couple of weeks ago, the biggest threat to the banking and credit union industry right now are the mega banks. I still believe those are the bigger threats.
Really? Okay.
Yeah. I mean, the number one bank chosen by millennials remains B of A and Chase, right? As much as millennials like to, hate the big guy, right? That's where they're banking. They like the fact that they're everywhere. They offer kind of an OnStar mentality. Mm-hmm. If all else is broken, I know they got thousands of operators nationwide. They even got branches in the middle of nowhere. So they like that kind of that. It's not all about politics and social issues with millennials. Like us, they have very specific needs. They want to reduce the chore of banking. So they view the bigger banks as offering those solutions. And same with Capital One. I mean, Capital One's a mega at this point as well.
Yeah.
Very popular with millennials. But those are the threats.
Really?
Not just neos.
Because I was going to ask, my next question was going to be, and it was almost kind of the theme of your panel discussion, how to challenge the challengers, So, because somebody said, and it may have been you, building relationships, turning data into actionable information. So you talk about that real quick?
Yeah, again, I think challenging the challengers is about a mindset. I think you have to ask yourself first and foremost, as a brand, who do I want my credit union to be when it grows up? And what impact do I want to have on the households I serve? Notice I didn't say members. Let's focus more on the households, right? And, in order to do that, you're going to have to look at data first. We already talked about the challenge of silos, right? Data over here, data over here, data here. You're going to have to create middleware to bring that data together. Ultimately, a bank will survive based on its ability, or credit union, on its ability to interact contextually and relevantly with the audience it serves. And I don't care if that's in branch or digital, it's got to happen. Now, right now, because we're in this, post pandemic kind of mode, we're seeing that mobile use went through the roof, right? I think FIS reported a year ago a 200% increase in mobile use. So mobile first is a really good place to start developing kind of like the data leverages that you need to have more of a holistic approach. But what I like to do is focus on the bad examples. So, I was one of the investors in Move, and I sold it in 2019. And I bank with Union Atlantic Bank here, a $25 billion bank in Richmond, Virginia. They're buying banks left and right. Continually, they're sending me messages that I should consider planning for my retirement. I've already retired twice. They saw the amount of money that went into the account, and then, by the way, went right out the next day, right? So the triggers were there, the data was there, the information was there, the insight was there. The behavioral change to do something about it was not. And I have a business relationship with them as well. Same issue, good amount of money. And by the way, their CEO for many years was the chairman of the American Bankers Association. And I stood next to him talking about the value of data. So the irony is unbelievable. The other example is they're constantly reminding me, for whatever reason, that I should save for my kid's 529 account.
Oh, really?
Okay, which is great because one's 24, and now, as of yesterday, got a job by Revolut, who's a neobank out of London, coming to the U.S. She's going to head up U.S. recruiting, and then the other one is, my son's 22. I have to think about it because I'm getting that old, and he's one semester from exiting. So 529 is the least of my concerns.
Yeah.
Their college expenses are paid for. One of them's living in my basement. That's a whole nother issue. But that'll change soon now that you got a better job. But,
do they have a plan for that one? So
they should. They should.
You're right.
Yeah, home equity loans. Build a spare office for your child that's working from home.
Yeah, I love asking you questions like that because you're so close to the challenger. I guess the challenger. I don't want to say mentality, but obviously being at Movin', you could classify them as a challenger, I guess, or at one time.
We were. Movin' started out as a direct-to-consumer model. They ran for 10 years, and it's extremely expensive to run that. They made the pivot last year to go B2C, and in essence, we offer APIs and SDKs that are built around financial wellness that allow a bank to leverage data to engage in a very contextual and relevant way. Online, mobile first. Eventually, we'll do a web version as well. The thing that's interesting about the neobank industry right now, and I looked at some of the stacks or some of the statistics. Here's an important one to think about. When the pandemic started, Cornerstone reported, I'm reading it right now, 4% of millennials viewed a digital bank as their primary FI. That number in December of 2020 jumped to 15%.
Wow.
This is right out of Shevlin's mouth, right? So, and I've seen that number very close, produced by other analysts and research firms as well. The other thing that I like to look at is the market valuations. So yesterday, Mark Cuban's bank, it's called Dave, is anticipated to do a SPAC, a $4 billion anticipated. Okay, this is something that a year ago, or 2 years ago, was worth about $600,000, right? It is amazing. And it's not, they call it Dave, by the way, because it's Davey versus Goliath, right?
Ah, nice.
Credit unions were supposed to be the Dave, right? Now you got a real Dave, funded by Mark Cuban, worth $4 billion. So, they understand it. The neobanking market size in 2020 was valued at $34.7 billion. They expect by end of next year, it'll be at $47.7 billion. That's the amount of market capital out there and cash rules. We know that. So you're going to see challenger banks buying brick and mortar banks. It's already beginning to happen. Revolut's coming in from the UK. what are they going to do? They need a bank charter. I don't know if they've established it yet. Are they going to buy a bank? That seems to be with enough, if you have enough cash, probably the quickest way to establish a foothold.
Yeah. And have a physical presence. Is that kind of the?
I guess that's a big question.
Equating it to Amazon opening up. They're opening up physical stores and malls.
Yeah, pop-up stores. Yeah, pop-up. And you bring up an interesting point, and that is that branches are not bad, right? Having too many, may not be wise, especially if you have a weak digital presence, or you're not able to deliver truly in an omni-channel experience, or you have too many bureaucratic rules that impact the member experience. So branches can be good. I think there's a real place for them, and I do think that some of these neobanks, as they expand, are going to open up their version of what a branch looks like. Mm-hmm. They will not do it at the same scale. They will do it completely different. Maybe a little more like Capital One with their Capital One cafes. Yeah. And frankly, I don't quite understand that. I asked my son about it. He goes to one in Richmond. He goes there for the coffee only. But then he said, I don't know why I go to a bank for coffee. I said, you go because it's free. And he goes, yeah, that's why it's free.
There you go. Well, that's smart.
Free's not a long-term strategy, believe me.
No. You brought up another kind of a neobank or a neo financial institution, and it's called Cheese. So Cheese, this sounds like it's kind of, I want to say it's encroaching on credit unions' territory, but what they're doing is very credit union-like. So
if I remember, they're focused on small business in the Asian market, and they're trying to create a real strong affinity with those individuals and those small businesses. And small business is a huge, open frontier for any financial services provider, bank, credit union, neobank. And I think it's an area that's ripe for neobanks as well. Already American Express, Plaid, Stripe, have really good business presence, but not full-fledged banking. Although Square's now moving into that realm. But they're focused on a niche. And that brings up another point. I don't know if you caught this in Stessa's comment. She's really down on like over niching. She brought up specifically teenagers. She goes, there are a lot of financial institutions out there that are talking about creating banks for teenagers. And she said, I think it's a bad idea. Yeah. And I don't know enough about it to say it's a good or bad idea. I try not to remember my teenage years, nor my children's. But at the end of the day, we were all teenagers. I picked my bank and my financial institution at the time when I moved here based on who helped me get a mortgage the soonest. Yeah. Right. So, in many cases, my children have picked their bank because of where their dad banks. It's easier for me. It's like, hey, Bobby, if you need some money, you want it through Square, do it through our bank. It's a lot easier, right? This P2P is amazing. Same with Sarah. Although now she'll be banking with the competition, I guess, but she'll probably sucker me into it too. So we influence our kids and where they bank. So I'm not so sure overly building a niche is the way to go, especially on demographics, traditional age-based demographics. Where I get interested is when I hear banks like one in it's either Florida or Georgia called Fitness Bank. It's started by a community banker in Georgia who's wants to spread his wings. He's going to focus on runners. So imagine the partnerships, Garmin, Nike, places like that. I'm talking to a fintech. Actually, it's not a fintech. It's an e-commerce provider, and they focus on active lifestyles. Okay, outdoors, men and women, from runners down to people that camp to boaters, and they offer really strong discounts through like West Marine, REI. I mean, surprisingly cashback discounts. He came to me and he told me, "Hey, you know what? I'm sending checks every month as a bonus to millions of dollars in checks to my customers worldwide." I'm like, well, why don't you do it as a debit card? You could generate some interchange income. Now he's like, I'm going to create a challenger bank specific, for the REI crowd, right? The people that really live and thrive, the active junkies of the world, right? Brilliant idea. Another guy in Minnesota, different from the Bitcoin guy. He's a big lover of recreational vehicles. He makes a lot of money financing them at his bank. He wants to create a bank for the people that roam the country in Airstreams or other RVs. I forgot the name of that movie that just won the Emmy, but that's the market he's going. I think it's called Nomad.
Yeah.
That's who he wants to go after. Now that's not those are behavioral market segments. They're not traditional. I like that. I think there's a possibility there. I'm a big believer that you can't be all things to all people. So if you can find a way to carve out some niches that are based on affinities towards certain, products, services, beliefs, there's potential in that. You can truly differentiate and provide something of service.
Would you say a field of membership is a niche?
It can be. Yeah.
Already captured that?
When I was with Affinity Federal Credit Union, we made a big push to go to SEGs, right? Because AT&T was downsizing. But at the end of the day, our claim to fame was built upon, Western Electric, which was an AT&T manufacturing division. That's where our blood and sweat came from. We focused on them. As you start to become acting more like a bank, and sometimes you need to, because you got to get the capital and you got to build branches and move toward a community base. It can be tough. You lose a little bit of your soul conceivably, but times are changing. AT&T is shriveled to almost nothing these days. So it made sense. In this market in Hampton Roads, I've got probably 12 credit unions I can think of that are military based. Some focus on the Army, some on the Navy, some on the Coast Guard. It's really interesting. At the end of the day, though, because of the way their charters are done, they're competing against each other.
Yeah, it sounds
and
like
I expect we're going to see huge mergers coming out of it.
Yeah. Oh my gosh. Yeah. Didn't think of that. I want to go back to, what was it? Fit Bank you talked about for
Fitness Bank.
Fitness Bank. So if this person who created it and they're bringing in all these kind of partners like an REI and things like that.
Garmin. Yep.
Yeah. So can they offer, an attractive offer to a new customer would be, hey, you get a discount on REI.
Why not?
Garmin stuff. That would be very attractive to a new person coming into.
Which takes us to kind of the issue of what is financial wellness, right?
There you go.
If you're a bank or a credit union, you're not in banking, you're in financial services. Right. And financial wellness is not to be confused with financial literacy. And you know how I feel about financial literacy.
Yes.
I get offers to tell me, they're like, hey, you should sign up for a financial literacy program. You're calling me financially illiterate when you do that. Financial literacy as a whole is not done real well. Financial wellness, on the other half, is kind of like, how can a bank or credit union have an impact on the households that it works with so that there's a tangible benefit from a financial perspective. And that can be as simple as helping a household increase its wealth, helping a household make the right decision as it pertains to a mortgage. Sometimes that decision or advice, it may not be, hey, buy my mortgage at, Bryan's credit union. It might mean, Navy's got a better rate, go there. You can create loyalty and foster relationships with households by looking at that. But going back to, Fitness Bank or, this guy in Colorado that's building, this new fintech, why not use your scale and or your affinities to present tangible offers? Okay. Strategy Core is a great example. Why do we pay for weather apps, right? I pay $39 a year not to have ads in my weather channel app. All right. I also pay, this is a crazy one, $3.99 a month to be able to cut off somebody's head and put it on someone else's body as a cartoon. But no one's willing to spend $49.99 a year because there's no damn value and it's a commoditized industry. It doesn't have to be. Present real value. How about this? For $4.99 a month, I get cell phone protection. I get roadside assistance, things that I'm already paying for. Bake that into the digital banking app or into your companion app or into your challenger bank model. Or if you're one, this fitness guy, negotiate with Garmin for 5% off, the Garmin watch or Tag Heuer, or, there's dozens of different things that we're all passionate about. None of us are passionate about banking. Anyone that tells you they're passionate about banking is full of crap. It's a horrible thing that we have to do. It's a chore, but we can make it, less painful. We can reduce the chore and we can leverage economies of scale to present more value. So I think that's where, this RV guy's going to come in.
Yeah.
Why wouldn't Airstream go to him and say, I'd like to advertise on your mobile apps? Like, let's negotiate a deal. So the only RVs that are being marketed when you do an RV loan it's just the back of an Airstream because it's iconic. Everyone knows it, right? And anyone that does RVs, everyone would love to afford probably an Airstream. I'm guessing, but that seems to be the hot one out there.
Pretty cool.
Yeah, they look cool. I like the retro thing, but so there are ways you can do this, right? You can go out there and find value and do it. Again, that goes back to the term affinity. You've got to market, do as much as you possibly can, and it's all tied to finances. Helping save money is like on shopping is legitimately financial wellness, right? You're helping them save, and I can have a counter that shows year to date, Bryan's credit union has saved $512 for you. And isn't that worth $49.99 a year? Yeah, why not? And there are apps out there like Revolut that offer a free version, a premium version, and I think that it's like the super double duper version. And it's not cheap. I think it's $6.99, but there are tangible benefits in there that if I'm going to be a real user of the app, it'll save me money.
Yeah, well, that brings me, and you've already really answered it, but I have to ask it anyway. But what can create, based on what you've said so far, and these other neobanks or these new ideas of banking, what can credit unions glean from a neobank or a challenger bank? What can they learn from those folks that they can implement in their shops? Because again, we go back to the field of membership. Essentially, that is a niche. So how can you really take advantage of that and talk about better serving your members? What better way can you do that?
I'll use Chime as example. I think Chime is approaching 4 or 6 million users in the US alone. I think Revolut's in the 5 to 7 million range. So there are not a lot of credit unions out there with 5 to 7 million members, right?
Yep.
We can take Pentagon and Navy out of the equation for a minute. What they're doing is, first and foremost, they've created a mobile first app that reduces the chore of banking. They made KYC, enrollment, account funding painless, simple. And the technologies are out there. Q2 recently bought, I think it's called ClickSwitch, which allows you to, with a click or two, to change your direct deposit.
That's right.
For me, direct deposit's a pain in the unit. For me to have to go to Union and say, you guys stink and you ignored me when I needed you. That means I got to do work, right? But with a click switch, if a neobank came to me or a credit union came to me, and for example, let's say they had a better than average money market rate, and I want to park some cash, you made it easy for me to switch. I do it, because it's such a commoditized industry. The way you keep me, though, is by adding me more value. So I think that's a big part of it. How easy are you to work with? What advice do you bring to the table? How tangible is your position of financial wellness? Once a member, always a member doesn't mean diddly squat. Okay, it sounds like something the mafia says. That's not the point. The point is you need to be able to offer something that tangibly recognizes and rewards households. So that the household's like, well, why would I move from Alliant Federal Credit Union because they're closing the branch? They still give me a ton of value, right? I get a tangible return. Or, they waived fees on my safe deposit box because, I maintain a $100,000 balance or $10,000, whatever it may be. Create those tangible offers. I think that's going to be the way you kind of offset it. The average credit union fundamentally has just about everything a challenger bank has. Almost all of you have a mobile app. If you don't, you shouldn't be in the business anymore. But you got a mobile app. You have physical branches, which are an asset, right? Maybe you have too many. That's okay. It costs a lot of money. Close some of them, retool them. But you've got these OnStar centers where people can go when they need help and they can get advice. Now go out and find a way to offer, a discount that's tied in some way to your, either your field of membership or to the community that you're in. And if you have an ability, develop products that are differentiated. And don't be afraid of charging for things that have tangible value. People like me will pay money to cut someone's head off and put it on another body, or pay for a weather app that just doesn't have that little ad at the bottom. And there's a lot of, there are millions of people doing it. And we're in this app economy right now. And we're also in this subscription-based economy. The market is used to subscribing. Why can't banking be, subscription as a service?
Yeah, you guys talked about that too as well, right?
We did, just a little bit. We touched on it. It's something I'm passionate about. I think that the reason we don't do that is we have yet to find a way to add enough value that's truly tangible that people are willing to pay for. And we're also fee adverse, or the industry as a whole. Even a lot of banks are fee adverse. They hear the outcry. Well, That's because you're not offering something of tangible value.
Yeah.
There's a value swap that goes on between, what you're offering and what you charge for it. And you got to determine what it's worth, and then you can build it.
Well, on the same tack, I think it was Ted who mentioned give customers a reason to check in with you. Can you expand on that one? Because I thought that was brilliant.
Yeah, digital onboarding and several companies like them are really big on creating what is known as a customer journey. I don't know how many times I've opened a relationship. Either maybe it's an investment relationship, maybe it's one with like Betterment. I have some money at Betterment, or at First Advantage Credit Union where I used to bank. The problem is I would open the account, it became a set and forget.
Yeah.
So they figured he opened the account. I opened the account because I was able to get $500 back on a GMC truck. The dealer said to me, hey, we've got a deal where if you buy if you're a First Advantage Credit Union member, this is several years ago, probably 8 years ago, you'll get $500 back. Go down there and open the account. I did. I opened it with $20. The bank, and I saved, right? I gained $480. The credit union never engaged me after that. It was years before I finally heard from them. And I heard from them when I got a bill. They purged my account and sent me a bill. Now, obviously, I got out of it because I know how to manipulate these pieces. And the CEO is a friend of mine at the time, was Casey Duplantier, who's retired. But I mean, those are things that are just simply stupid, right? The lack of engagement, any engagement, is astounding in financial services. Now, the fact that you can now, because of digital and because of data and turning it into actionable insights, you can leverage mobile to have real meaningful engagement. And that's what Ted's trying to do. He's saying, let's create journeys. Let's find ways that we can engage our customers on a regular basis. How many bankers or credit unioners went out there, CEOs, and called the top 20 customers at the beginning of the pandemic and just said, I'm here for you. We're here for you. What can we do for you? Jill Castilla does it at Citizens Bank of Edmonds. Bankers, your enemy. They're doing it. Our industry needs to be doing that as well. And if we are doing it, we're not hearing the stories enough. They're talking to themselves. That story needs to become out, needs to be made public. So any kind of engagement is good engagement. You have to stay under people's noses.
Well, and I look at that and I look at and this is totally going into left field here, but I kind of relate it to like YouTubers out there or the entertainment industry where they keep their audience engaged almost on a 24/7 cycle, and they give them reason to check into their Instagram account. They give them reason to, hey, tune in next week for our new video on YouTube on this. Or so why can't a financial institution do something like that? They
can. I mean, I bought, I don't know if any of you are from Austin, Texas. I was on a phone call with my friends at Q2 and with a banker, B1 Bank. And the two guys are like, oh, I see you're wearing a cricket shirt. And I'm like, cricket, like the sport? It doesn't seem like a Texas or Louisiana thing. No, it's a shirt. It's a branded shirt made in Austin. I heard about it through Instagram. So I don't know what happened, just me merely talking about it, but an offer popped up, right? And lo and behold, I went out and bought two of those darn shirts at $80 a pop. But I mean, that level of engagement, it's kind of a subtle engagement. It made a lot of sense. I'm a big believer, in social. I mean, I believe social and engagement, rule number one of any CEO right now or any CMO. If you're not actively engaging your audience in a digital first as well as on a personal level, you're missing a huge opportunity. You're missing the best part of banking, because banking is the epitome of a people business, right? You've got to be engaging people in order to help people really, move toward a situation where they're, can live well within their means, which is the outcome of financial wellness, right? Yep. So a lot of opportunities.
Yeah. And you mentioned to me also that these are exciting times as well as scary as they might seem. They're also super exciting. There's opportunity out there for sure. And
I mean, if you don't feel that this is the most exciting time in your banking career, either you just started or you're crazy and you shouldn't be in the industry, because this high tech, high touch stuff that James Robert, me, the Brett Kings, and all the intelligent marketers that are out there, and there are thousands of them. We've been talking about it for years. Well, today, now we've got that ability between technology and social and personal interaction. We can create a high tech, high touch environment. And the neobanks don't have the touch part necessarily.
That's right.
Not in a physical sense.
Yeah.
So I think that getting back to the branch can be conceivably a special sauce for the banking and credit union industries.
Mm-hmm.
And the smarter ones are trying to figure that out. I'm not saying that we're all going to open up coffees. Not even Starbucks wants to be a Starbucks anymore. Cafes are not the answer. Ask my son. But, having centers that are built around engagement, problem solving, mortgage applications, hand-holding for first-time car buyers, home buyers, a married couple, things that are built around lifestyle events, that's valuable.
Mm-hmm.
Now, the challengers are doing that, but only in a digital format. If you can figure out how to do that digitally and physically, I think you've got a great formula.
Yeah. Tom, did you want to add something there? Because
just a comment and then a question for Bryan. Sure. So it was interesting. Is Fitness Bank rates gives you dividend rates, savings rates based on your number of steps.
I didn't even see that. That's
so
crazy.
500 steps gets you the highest rate of 65 basis points.
Oh my God.
So physical fitness meets financial fitness.
But you have to engage with their app. Going to your point, you have to engage with their app where you're tracking your steps through their app.
Yep.
And so it gets exactly to where you want to be. They're opening the app to see how many steps I've got to get to that next tier as well. But
that is cool.
Yeah, that's really neat. But the question I had for you, Bryan, is to understand maybe a little bit better the success of these neos and these niche banks versus credit unions.
Yep.
Credit unions, my thesis has been that credit unions become very adequate at a whole bunch of things. The depth and the breadth is very vast. We have a whole kinds of products, 20 different CD terms, and 3 different money markets, and 2 or 3 home equity types and whatnot.
Yep.
Whereas the niche banks like the Fitness and the Revolut and all that, they focus on they have a very narrow product set and they do it exceptionally well.
Yeah.
Is that a problem for credit unions that we need to thin it out a bit to?
Yeah, I think it's a challenge
in certain things as opposed to.
Yeah. I think it's a challenge. It's a challenge for most. They're trying to be all things to all people. It's very easy for, one establishment, one management team to offer product X, Y, and Z, and then there's some churn in the business, and all of a sudden you added to it. Look at cores and the number of accounts that are on some of the core systems at some of these banks and credit unions that have been put out the pasture, but they're still open. The effort to migrate from account A to account B had never really occurred on a wholesale level, which reduces your operating costs and also makes it easier for your team to sell. I think some of these banks, and I had about a $4.5 billion portfolio at Summit Bank in the early 1990s, and I was charged with selling my deposit products. At the time, we had CD rates that made a difference and money markets to boomers, 55 and over. And we focused on 2 products exclusively. And I took the portfolio from 600 million to 4.4 billion in 3 years. And I needed it because we had to fund the loans. And I did it because I eliminated a lot of the chatter in the noise with all the other additional accounts that were being sold to the aging boomer. CD, A, B, C, D, and then all the different terms and maturities on them. And then same with money market, below 5,000 X, 5 to 15 Y, 25 to 50 plus, and it became chatter and noise, and there was not a lot of cross-selling or focus there. So simplifying it and reducing your product portfolio where it makes sense is the way to go. Or, pick your market wisely, more intelligently.
Right. And I think going back to something you said early on too, I think you're going to see more of the fintechs buying banks because they have the charter, which is a pretty high hurdle, and they've got the infrastructure. So they've got all the KYC, the FinCEN, they've got the relationships with the Fed and ACH and all that. And I think it becomes a very strong value proposition for them just to pick up a small community bank. Doesn't matter if it's in Minnesota or Jersey, where I am. I
used to be in Jersey. I lived in Princeton for years. So.
Because it's all digital. It's worldwide or nationwide, depending on what they want to do with it.
So I've got a question. I've got a question for you guys. Let's talk for a second about bill pay. Right? Why is with the bankers I work with, not the credit union folks, bill pay has become an afterthought, and I guess it's because the average consumers going bill or direct, right? Exactly. I set up an ACH with Dominion, but imagine the amount of data that you can gather from a bill pay experience I just don't understand why the Allieds of the world aren't really all over that. I know Kelly well from Ally. I mean, they're sitting on a treasure trove of data. Companies like Blip, same thing. There's just so much information that's there that you can turn into actionable insights, and it gives you a reason to engage, right? It just seems like it's been forgotten. What's going on with it?
Yeah, I think part of it is we've abdicated a lot of that to these third-party companies. So we don't see the data, and we need to see that. And our cores, more modern cores, of course, they can handle that and to see that information. But then it becomes, how quickly can we action on it?
Yeah.
Where are we with AI and really actual AI or analysis that's not coming to you when your kids are already 22 years old?
Yeah. Well, even in digital banking, even the digital banking experience, I'm clearly seeing the ACHs. I'm seeing the debits and the credits coming from the billers. So why isn't there a digital banking provider that's giving me all that information that I can really utilize? Part of financial wellness is helping people lower their utility bills. These are bread and butter things that became a major problem for some of the underserved or unbanked in this country over the last 16 months. People couldn't pay their bills. People couldn't pay their rent. So there's a story in all that data, all that biller data, whether it's your bill pay solution, someone else's bill pay, or the biller direct model. There's got to be a way that banks and credit unions can leverage that to get closer to the audience they're serving and to provide more relevancy.
I agree.
Mike, have I talked too much?
Not at all. Not enough, Bryan. Because I was just looking at one of the comments in the chat, and I think everyone saw it. One person said, Cody said, small and mid-sized financial institutions are struggling to serve members based on personalization data. Legacy systems are making it harder to extract the data sets and consume the data in service channels. So it's kind of like what we were just kind of talking about there.
It is. The cores are I think the cores have a come to Jesus and realize that first and foremost, they're in the data and experience business. Right. Instead, it's like, oh, we're a technology platform. We bring it all together. We make it easier for the bankers. At the end of the day, now it's not. It's about delivering an experience and leveraging data. Mm-hmm. And I think that the cores that kind of recognize that, it'll be better. I think a good example would be Jack Henry and Banno, although, I know they've struggled to execute in some ways. The mindset behind Banno is exactly that. We're going to leverage data in our day-to-day transactional analysis to make sure that offers are in line, and predictive insights can be used to make sure your products and services are in time with member need. That's what it's all about. I shouldn't have to ask for a loan, for example. You should see, based upon, especially over the last several months, you probably see some pretty stark drops among, for example, restaurant workers in income, right? And why aren't there microloans that are being offered them quickly?
Yeah.
And then you saw that big blip, $1,400 or whatever it might have been a couple of times. How the banks or the credit unions gone back to that member then and said, hey, you just got yourself a windfall. The average American allegedly only has $400 in emergency savings. Let me help you put that money to work. Now, granted, they may need the money to survive, but based upon spending data that we've seen over the last year, a lot of Americans spent that money instead of saving it. So, which is a shame, but it is what it is.
Being proactive on that type of stuff, on that information.
We're a nation of consumers. That's the bottom line, and that comes with a pro and a con. The pro is it drives a pretty comfortable economy. It keeps small business kind of alive, as well as the big e-commerce players. But at the same time, I believe there's a lot of risk. People are overspending. They're overspending yet again. Real estate prices are through the roof. They're not going to stay there. They're going to settle back. It won't be a huge crash, and it'll go back up again through time. Right. But right now, it's frightening. But there's just so many different ways that a credit union can look at their membership and impact the experience.
Yep, indeed. Well, we have 6 minutes left. If anybody else has any questions for Bryan, or Bryan, if you want to tell us something we don't know. Is there anything kind of percolating in your brain that none of us know out there, or I know that's
there's always something percolating in my brain. It's just whether or not I'm willing to share it. It's like I said, it's a really exciting time. I made a promise to myself. The reason I stayed out of retirement, I would call it, I can do advisory work, is I'm having a lot of fun, right? And having fun is important to what we all do as, credit union leaders or as bankers. If you don't like what you're doing, if you don't see the opportunity to de-commoditize the industry, you're probably in the wrong place. There are incremental things that you all can do right now, any day, to show your differentiation. I think financial wellness is a huge, huge benefit of having a relationship with a bank. And financial wellness does not apply only to those with no money or the underserved. People with a lot of wealth have very complex financial needs. And today they rely on the Raymond Jameses of the world, predominantly advisor roles, which charge 2.5% of net assets under management. It's expensive. Every single demographic needs its own flavor of financial wellness. Everybody needs advice, and credit unions need to figure out how to do it from kind of a cradle to grave perspective. Stop focusing just on millennials. Stop focusing just on teens. Stop focusing on the traditional demographics. Focus on the milestones that we as human beings and as families kind of go through, and present your product so that the relationship between what you offer and where that individual or family is at a given moment of time is very meaningful and relevant. And you're going to do that through data and engagement.
Well said, sir. Well said. Well, this has probably been the fastest hour that I've experienced in quite a while, because it seems like we just got on.
And my power didn't go out. The power stayed on.
I know, the thunderstorm has passed. Yeah. Bryan, you're safe.
I also didn't realize I had the badass banking thing on there.
I like it. I was just going to mention
to take it down.
I was just going to mention that. Where can we find you? Because you're one of the
I haven't been doing it for a while. So the whole concept behind Badass Banking originally was to bring financial technology companies and banks and credit unions together. People that are really trying to change the industry. I don't know if banking can be fun, but I think it could be pretty badass. And that's going to be through that high-tech, high-touch environment that we've been talking about for years that we actually can now actually build.
Yeah. Exciting indeed. And we can also find you on Facebook and Twitter. You're one of the more prolific social media posters out there, Mr. Clagett. And
I like to mix it up. I do a little, fun photography of, my life. And then I get right into, debates with Dan Berger and other people like that. There is a really good community of fintech. I'll call them all bankers out there that really care. And there's there's just a lot of value in their thought, and any of you can go out there and engage them in moments and get some really nice free consulting and advisory from them. But there's a lot out there that's worth listening to.
Good stuff. All righty, sir. Well, I'm going to let you get back at it. And thanks again for your time. As always, Bryan, just some great nuggets in this talk today. So we appreciate your wisdom and all the insights that you provided today. And I think our audience is very grateful.
Special shout out to Gary Coates, by the way.
Yes, indeed.
Hey,
indeed.
Gary. All right. Appreciate it.
Hey, Bryan, good to see you. Thank you.
Good to see you, buddy.
Yeah. We need to talk more. I'll call you.
Call me.
All right, gentlemen. Well, thanks again. Appreciate it, everybody. Be well, be safe. And Bryan, stay clear of those thunderstorms, okay?
You got it. Thank you.
All right, man. Thanks again, everybody. Thanks, Tom. Well done. See you guys.